Everyone, by the way, this is Darren Blomquist who works for auction.com. He's the head economist. You also write for HousingWire, correct?
Yeah, we do have contributed articles for
Yep.
HousingWire. Yep. And some other places as well. But
Yeah.
knows I love to pick your brains as well about what you see in the market
Yeah.
and um what your kind of general sentiment is toward the market and how are you responding to it in terms of what you're buying.
Darren, real quick, I wanted you to share in our conversation we had the other day. You mentioned that HUD was actually lowering their numbers a little bit quicker. They're going to be changing some of that.
Yeah.
That's huge. That's
Yeah, it
actually,
is huge. And I can share that
yeah.
today. I mean, that's public knowledge. There's been not a lot of people read them, but they put up their mortgagee letters
Hmm.
that to talk about stuff like that. And yeah, so as of September 15th, actually, they did a price adjustment where they adjusted their haircuts. But we can talk about that. I mean, sometimes it takes a little while for that to actually show up in the numbers, but um, yeah, we can talk more in depth about that if you guys want.
Perfect.
So, um, you want me to jump in then?
Yeah, jump on into the presentation. We'll go through that. And if we have questions, we'll hit you with questions.
Okay. Yeah, feel free. Let's make it conversational. These are kind of some of the main themes I'm seeing right now in the data. I look at both our own data at auction.com as well as a lot of other public record data. Um, and this is kind of through the lens of the distressed market. So macroeconomic trends, I view those as a tailwind, meaning for distress volume, meaning more it's pushing more distress volume to foreclosure auction and REO auction, and that's really because it's really around the labor market, that weakening labor market, which really isn't showing up super clearly in the unemployment rate, which of course with the government shutdown
Yeah.
we don't have the unemployment rate, but there's some private job numbers I have here we can look at that does show weakness there. And then if you look at consumer sentiment, there's kind of a mixed bag. Consumer sentiment is way down. Wages are starting to slow down wage growth, although it's still fairly solid. Savings, if you look at the personal savings rate, that's coming down, although spending is up, and maybe that correlates. So I think there's some stuff showing in the labor market weakness, and then consumer spending weakness, which is of course a huge part of the economy. So that matters a lot as to what we would see in the distress market. So that's economic trends. And I can dive into more of these in a minute, but housing market trends are actually a headwind, and you all would probably know that from uh, the front lines of the housing market. But in terms of actually selling properties at auction, it's a headwind because of the slowing housing market, slowing home price appreciation. Um, I do think we might be seeing some early signs of a floor there in the housing market, where it's very early, where we could see some actually a little bit of rebounding strength in the housing market that could help. And that's really a message for our sellers on our platform is, hey, you need to pay attention to the retail housing market because our buyers are paying attention to that and it matters to them. So you need to potentially adjust pricing or just have your expectations in terms of what's going to sell at auction. Distress market trends specifically, also a tailwind. We're seeing that manifest in more foreclosure starts. More properties that start the foreclosure process are rolling to actual auction. And so there's growing momentum there. And then the pre-foreclosure market, which I don't know if you guys pay or your audience pays too much attention to, but it's something we've been looking at more closely, like what's happening when someone goes into default, but the property doesn't make it to foreclosure auction. And we do still see a lot of sales in that window.
I'll tell you, Darren, there's a lot of investors who are kind of focusing in on that right now. I know that from one of the masterminds I'm in, they're hitting that pre-foreclosure market, trying to stop it from getting into foreclosure. So you're probably seeing some of that.
Yeah, for sure. Yeah, and we've recognized that, and we've actually uh, enabled in the last few months folks, individual homeowners, to list their properties on auction.com. It's something we call Smart Sale. And it's gaining some momentum. So giving those homeowners an opportunity to actually open up their property, not just to that local investor who contacts them through direct mail, but to potentially a nationwide network of investors like yourselves who are looking for those properties.
Are you seeing a lot of the pre-foreclosures convert then into like a share sale, then convert into REO? Because I see the numbers every month from like Adam and other sources where, the number of, 30, 60, 90-day delinquencies is increasing, but well, how does that go down the line type of thing from a supply chain?
Yeah, I think that, let me jump, because that's a great
And if
question.
you're going to cover that later, that's fine. You can pivot that to that later.
Well, I want to jump to what you asked because I have a lot here and I probably won't be able to cover it all.
True.
So we can jump around a little bit, but there's
and we're seeing the uptick in REOs. It's just not as great as an increase as you hear on the headline pre-foreclosure spike.
That's right. Yeah. And so, I mean, here's the what I would call the top of the funnel. You see these SDQs, seriously delinquencies, starting to tick up among all kinds of debt. Auto loan, credit card debt has already been going up for some time. And then, of course, you have this huge spike in student loan delinquencies recently due to the debt forgiveness phasing out. But anyway, the mortgage debt is now mortgage debt, seriously delinquencies are above pre-pandemic levels. HELOCs are above pre-pandemic levels for the last few quarters. But then where is that going? And there's some other stuff in here. But this is a little bit of a maybe esoteric thing that we look at very carefully, but I think it gets to your question is like, how many of these properties that are going delinquent, or these loans that are going delinquent, are actually making it to foreclosure start, and then also foreclosure. BTA is our jargon for brought to auction. And so brought to auction on the auction.com platform. And then I'll talk about actually making it to REO after that. But we are seeing those roll rates from delinquency to foreclosure start to tick up again here. And they actually went down a little bit in 2024, which surprised us because they had been trending up since the moratorium back in 21 or 2021. Dropped down a little bit in 24, but they're coming back up now. So more of those properties that go pre-foreclosure are actually making it to foreclosure auction. But to your point, we still have, when we look at the market here, and I'll again skip around a little bit, but actually let me get to the REOs. When we look at on our platform, this green line is where we're at in terms of just benchmarking to Q1 2020 levels, which is kind of the last so-called normal market pre-pandemic. We're still at 44% below or 56% of those pre-pandemic levels with foreclosure auctions. If you look at REO auctions, those are at 43% of pre-pandemic levels. So 57% below pre-pandemic levels. So those haven't been as quick to come back. And part of that is because a lot of these properties that are going to foreclosure auction, more are selling at foreclosure auction. The third-party sales rate has gone up there. So that's a little bit different dynamic in this world. But one thing we're seeing is vacant REO auctions, which I believe to many investors, that's
our bread and butter. Yeah.
That's what appeals to you. We're seeing those rise quite a bit to a 5-year high.
That's good there for us. Yeah.
And what we're seeing too is it's decent condition, like running or like built in the last 5 to 15 years, and still like it just minor cosmetic type of work. We're seeing more and more of those type of properties.
Oh, interesting.
Someone probably bought them in 21, 22, and now they're sitting on an auction site somewhere.
Yeah, we've seen a lot of that in the last few months. Some of them even they've sold as, early as like last year, now but on auction, already in foreclosure.
Yeah, that's interesting too, is that, and I don't really have that data in here, but when we look at the vintage of these loans that are going to auction, there is a higher a disproportionate percentage that's 2022 and later
Yeah.
loan vintage.
Yeah.
And I think that speaks to folks kind of buying at the top of the
I
market.
know the high end, if they have one
Yeah.
hiccup in job income, right, losing a job or something, that's
Yeah.
probably where they're at.
Yeah.
Yeah, you see a lot of those homes, you're right.